commodities. We are seeing a fourth straight day of declines. The Reuters Jefferies Commodities Index hit a 2.5-year high last week, but has been falling ever since. Among the biggest losers today, silver, again, cotton, and crude oil also down, as you see it down more than 3%. Joining me now from San Antonio, Texas, is Evan Smith. He's a portfolio manager for the $1 billion U.S. Global Investors Global Resources Fund. It had 38% return in 2010. Evan, is this just a short-term trade, or is the run-up in commodities over?
We definitely don't think it's over. I think what we're seeing is some a healthy pullback, squeezing out, particularly in some commodities that have probably run up a little too fast. Squeezing out some of the weak longs, perhaps some of the speculators. But we still think they're a pretty good fundamental underlying trend for higher prices, later this year or next year.
When you say squeezing out the speculators, we've seen this, the CME essentially tried to do that with silver by upping the margin requirements. Do you see the other commodities trading down as a direct link to that, or are you also seeing speculation in the crude market?
Oh, I think you'll always have some, form of speculation. You're right about silver. We are seeing, margin requirements. I think they've been raised 4 times in the last week. That will surely shake some people out. But I think, you're seeing de-risking across, across the board, right? Equity markets are down. Commodities, all commodities are selling off. Agricultural, energy, precious metals, industrial metals. So it seems to be just de-risking in general, not anything real specific to just speculators, in my opinion.
Evan, you said you're a long-time bullish in the commodity space, but you do think that gold will get soft, particularly as we get closer to the end of QE2.
I think that's a risk. I think you're seeing some pressure on silver right now. It had ran up pretty strongly in April. With the margin requirements going up, that's pulling some money out of silver. But I think investors right now are starting to, there's a little concern about what happens at the end of QE2. In our opinion, we continue to see generally sluggish, not a strong recovery, sluggish recovery. Jobs numbers, we're not seeing much of a recovery quite yet. Housing prices remain, somewhat stuck. They're not on the rise, and so we don't think the Federal Reserve is in an environment or in a position to where they can start to raise rates like many of their counterparts are doing overseas. Mm-hmm. So we've seen European Central Bank raise recently. India's central bank the other day, they've raised with a surprise 50 basis point raise. China's been tightening. Many other central bankers around the world are much further ahead of us, and that's put pressure on the dollar. We don't think that that's going to change much this year, and so we're seeing a bout of selling, a little de-risking right now, but really this low, weak dollar, low negative yield, real yield environment will probably persist here in the United States, which will be one of the underpinnings for commodities.
Among your top 10 equity holdings, at least 5 of them are oil or oil services companies, at least as of the month of February. If we don't get the jobs number that most expect tomorrow and we see a sell-off, would you be adding to those positions?
We have been adding to some of our energy names here with this pullback. We think crude is fundamentally pretty well supported. It might dip back under 100 for WTI, with this sell-off, but we don't see an imminent collapse. We've lost a lot of supply capacity out of nice light sweet crude capacity out of Libya. The Middle East is still very tense right now. Nigeria, we're seeing some supply losses there because of recent elections and resulting violence. Yet, demand in many parts of the world are actually on the rise. You've probably seen a little extra pickup in Japan ever since they lost their nuclear reactors. They're relying more on fuel oil and crude oil to fire their electricity, their power plants. I think we could see incremental demand for refined product in China. Mm-hmm. They're sitting on very low coal inventories right now, and some of the power plants are not operating, I think you're going to see backup diesel generators be fired up, and that will put upward pressure on some of the refined product as well. So we think there's some opportunity. There's some certain tight markets where we see particular opportunity near term.
Is your biggest holding still HRT down in Brazil?
It is. It is. It's pulled back like many other equities recently, but this is a company we invested in early on. We've made about 600% return for our investors thus far, even with the pullback. And it's a longer-term play, as they explore for significant amounts of oil in Brazil and off the coast
Amazon,
of Southern
right,
Africa.
Right.
Yep.
The CEO's been on this program. You also, in looking at the industry breakdown of your fund, you actually have more exposure percentage-wise to coal than you do to gold mining or some of the diversified materials. Explain that trade, and is coal going to buck the rest of the commodities in their trend downward?
We like coal right now. We've liked it for some time, but we thought we started to overweight that in the fall as we saw more cyclical industrial type commodities start to outperform. We thought that would continue through 2011 relative to precious metals. Coal right now, we're seeing consolidation in the space. There's with Massey Energy and Alpha have gotten together. We saw Arch buy International Coal Group. We've seen consolidation in the metallurgical and thermal space. As I mentioned earlier, there are significant problems of coal supply in China right now, and that's driving thermal coal prices higher. So, yeah, we like several of the coal stocks.
All right. Thanks so much, Evan, for joining us.